it's hard because, like a lot of value investors, you have to know your competency, and we're all smart people, and we all like to have opinions, and we all like to hear our own voices. So, that is one of the behavioral traits that you have to overcome, to think that you know more than you do. If I knew how to predict interest rates, as much as I'm enjoying this, we wouldn't be sitting here right now if I had that talent, right? Or if I could predict currencies or any macro thing, hell, I'm not even convinced if I can predict the presidential election outcome, which is terrifying in its own right. The way that I find is safer to look at it is to have the mental framework of, I don't know what interest rates are going to do, for example. My guess is that since it's hard for them to go negative, or at least hard for them to go too negative for too long, because they're so close to zero, if you're looking out 4 or 5 years, my guess is that they're up. And that they're, but at what pace, I don't know. And so that's my generally held belief. But in terms of a cognitive process, you look at it and say, okay, well, what happens in other scenarios? And it's not any different really from looking at the macro, any different than it is at looking at company-specific events, right? If this company can elevate their margins or keep their margins the same or see some deterioration in their margins, what are the outcomes? How does that impact the stock price or the price of any securities that they might be looking at? It's really no different to sort of look at the macro side and say, okay, I have an intuitive belief here, but what happens under the other outcomes, and how does my portfolio look like if this thing that I personally don't have confidence in for it to happen? I think it's improbable, but if that did happen, would I get killed, or would I just get hurt a little bit, or would I even somehow benefit from that? And so I think it's important to challenge everything. We had an investment, what was it, 2014. We were looking at an oil company that was not a particularly good oil company. And it was mostly natural gas, a little bit of oil. And they were going to merge with a private company. And so we looked at this and said, okay, this merger looks pretty interesting. And so that is a corporate event. And corporate events, I'm pretty good at looking at. And then the merger got a lot of hair on it. And, so I was digging in deeper and saying, okay, I can figure out, are they going to close this merger? And I figured, yeah, I think they are. All my work, all my experience leads me to believe they're going to close it. Now, certainly going into this, you had a clearly identified risk factor of, their fortunes are tied to the price of the commodity that they produce. And even though they're primarily natural gas, oil, there was a small portion of oil, but because oil at that point was so profitable, and natural gas had been beaten down over the last several years, probably a significant portion of their profits were coming on the oil side. And so, we looked at it, hedged the oil, hedged the commodity exposure a bit, but you're not thinking, and in the back of my head, intuitively, I'm saying, marginal cost of producing a barrel of oil is probably around $80, and, it goes below that for a little bit, but nowhere am I considering, on a geopolitical level, U.S.-Iranian relationship is changing, and Saudi Arabia is getting very concerned about that, and they're also not so happy with Russia and how Russia is behaving in Syria. Maybe Saudi Arabia does something that would seem counterintuitive to their monetary interests, but is maybe explainable by their national security interests. And if they do this, how long might it be before they correct from it? And at that point, the marginal cost of production is no longer the anchor that you thought it was. And the hedge that you thought that you had put on thinking that it was going to protect you from minor fluctuations is certainly not going to be effective when you see the price of oil go down by 50+% in the course of a year. And so that was something where I was very focused on the trees. The trees being can they close this merger deal, and I was right on that, and it didn't make sense because we got our face torn off, and it was something that I put out publicly, even with the caveat of saying hey, you have commodity exposure here, but it doesn't matter. It was not seeing the broader picture of saying listen, something irrational could happen here, and if it does, that is going to dominate all the analysis that you've done. And so, coming out of that, certainly have a great deal of humility over just the colossal mistake of it, but a real it's very reinforcing of that belief of you have to question everything, and the first step of that is identifying the assumptions that you are taking for granted, and make sure that you question. It's hard to question you have to question the validity of them, but the best way to do that is just to take, for the sake of argument, say, well, what happens if this driver that I expect to be in a certain band, a narrow band, turns out to be in a very much wider band? What impact would that have, and how would that change my my behavior? And I firmly believe we learn a lot more from our mistakes than we do from our successes. And one of the benefits of this business is you're making enough mistakes on a daily basis that if you can capitalize on learning from each of those, I think you'll do very well over time.